From London to New York, Sydney to Santiago, our global team starts every day with one goal in mind: to serve our clients.
We can circle back up tomorrow.
We help corporations and institutions grow their businesses and help clients invest and manage risk in trading markets around the world. We raise capital, lend money, extend liquidity, and provide strategic advice. We help governments build infrastructure, fund schools, and finance hospitals. And we deliver market-leading research and insight to issuers and investors. We bring global capabilities to local markets and develop smart, strategic solutions that help clients and communities thrive. We are diverse and dynamic, collaborative and innovative, trusted advisors and thought leaders. We are the corporate and investment bank. We are JP Morgan.
Thank you, and thanks everyone for attending the session. So I will talk a little bit about our outlook for markets for this year. And sort of for the lack of better word, our outlook is negative. You know, why negative? At the core of it is this increase in interest rates, you know, sort of unprecedented increase of interest rates over the past year. Sort of the terminal rates of Fed Fund, you know, last year we sort of thought to be around 2.75, 3%. Then it kind of shot up about 5, closer to 6. And the economy is quite a bit levered on the rates. You know, you have real estate market, commercial real estate, residential real estate. You have small businesses, private businesses, startups, which are dependent on financing, short-term financing, and their financing went through the roof. And then you have a consumer. You know, if you look at the sort of auto loans, increased, in some cases almost doubled. Mortgage rates almost doubled. Credit card rates, you know, went from 15 to almost 30%. You know, like, so all these different parts of the economy are negatively impacted by rates. So sort of as the rates moved up, we sort of turned more negative towards the end of last year. You know, and back in 2022, last year, we were positive. Many of you know that, and clients often ask, okay, what has changed? You know, and as simple as the rate equation have changed. You know, and consumer was came into this pretty strong. Balance sheet of consumer were decent. Corporate balance sheets are pretty good. So we thought last year that cushion of sort of balance sheet, both consumer and corporate, can actually get us through these rate hikes if the rates were to stop at say 2.75 or 3%, which is sort of what Powell indicated July last year. You know, and after July, we got August, we got a Jackson Hole, and story completely changed. You know, so sort of in August we were quite nervous around our call. We had a pretty bullish call on the market. We said market is going to go to 46, 4,700. You know, so I kind of realized late August, early September, it's just not going to work. It's not going to work. So we sort of scrapped our price target. And we said, like, look, we don't want to kind of sell it at the bottom here, but we are not going to go as high as we thought, you know. And then what has happened sort of, you know, clearly going into year end, there was some sort of positive market developments in terms of flows. So positioning was pretty low. And then the market moved sort of November, December. You had quite a bit of systematic buying, CTAs, vol targeters. Some fundamentals did marginally improve. You know, we had a China reopening, which was part of our bullish call last year as well. So that gave a little bit of boost to Europe and to emerging markets. And then came January. You know, in January, you had a strong seasonality. People invest in their pension funds. In US, you have these 401k flows that kind of pick up the pace in early January. And frankly, there was a bit of exuberance and speculation. You know, if you remember, Tesla stock doubled in January, went from $100 to $200. You know, the ARK ETF also went up. Cryptocurrency went up a lot. So there was a bit of a exuberance going on, which was anchored in the US at least in this thesis that Fed is going to start cutting the rate in the second half of the year. That's going to be Fed pivot. So while the US investors were kind of exuberant about rates going down, you know, in the Europe or global investors started investing in Europe because rates were high. So they thought sort of high rates means stronger growth, means value will outperform, cyclical will outperform. So you have sort of from the both ends, you know, which is actually inherently inconsistent. You can't have like rates high and economy growing and at the same time Fed cutting the rates. So we thought it was a little bit weird situation in January. Powell didn't help himself. Powell February 1st, and then later on in Chicago, February 7th. On both of those speeches, Powell was very firm that there's going to be no hard landing. So sort of, he would say like soft landing is something we strongly believe in, and he even declined to sort of acknowledge some of the exuberance that was occurring in the market. So he was asked a few questions whether the financial conditions tightened or loosened, and he wouldn't give an answer. Clearly, conditions loosened, making his inflation fighting job harder, but he wouldn't acknowledge that, and he even said that financial conditions didn't change, which was actually factually incorrect at the time. But market kind of took it as a very bullish sign. Market said, hey, look, Fed is actually now basically tailwind for risky asset classes, and of course, Powell got to regret that pretty soon. Not even 2 weeks after, all the inflation numbers started printing pretty hot. CPI, PPI, University of Michigan, all the metrics like core, super core, they all started going up. Inflation break even kind of made new highs. So Powell realized probably that he's losing a little bit of grip or credibility. So then he went to Congress sort of 3 weeks ago, 2.5 weeks ago, and he actually introduced this idea of hiking 50 bips, so basically picking up the pace of hikes, and rates volatility started moving a lot, clearly, and a disconnect started to appear between bonds and equities. As the bond yields shot up and they were very volatile, equities were disregarding that. They were disregarding both volatility and also the price action in other asset classes, particularly fixed income. So we turned even more bearish at that point. We said, like, look, there's a big disconnect here. Sort of the amount of increase in rates we saw in February, we said, like, look, Nasdaq should be probably 10% lower. And if you look at the European stocks reached all-time highs. So, I like to sort of just ask myself like a simple question: does it make sense? Does it make sense that Europe is trading at all-time highs? We have a war. We have inflation. We have this unprecedented tightening of financial conditions. We have a consumer which is gradually eroding. How can we be trading at all-time highs in Europe? So I said this doesn't make sense. So as I said, we turned quite a bit outright negative and advised sort of clients to go underweight equity or a long-short portfolio be short equities by about 8% relative to our benchmark, which is a pretty high active weight. So that's a little bit of a history of our thinking of market. And as I said, rates eventually driving recession. We had sort of penciled recession for the fourth quarter this year. We initially thought about mild recession. Now, what has happened over the past week made us believe that recession might not be actually that mild. So even our economists took down the GDP forecast by another 1%. So last week, here comes the last week, and I wrote something the day before yesterday. I said, it's a little cringy quote from Lenin saying, like, there are sort of decades where nothing happens, and then there are weeks that decades happen. But it did feel to me last week was one of those weeks, and what has happened, the cracks finally started appearing, and there were some smaller cracks before, but last week we had somewhat of a major cracks, I would say. We had the Silicon Valley Bank, a few other banks, smaller banks in the US, and then we had the Credit Suisse a few days back. It's a proper crack, right? Like it's an institution that exists for almost 200 years, just goes out of business overnight. So these are the cracks in the markets. Now, of course, there's some response and there's some firefighting, and we saw that similar in 2008. So of course, there's going to be some sort of, stop and starts, and market will feel a little bit that it was solved and the problem was solved, and then some new problems will appear, and eventually we think it ends a little bit like 2008, where you can't put out all too many fires, and then there's a little bit of inflection points for worse. So sort of last week developments in market geopolitics. I like to also highlight geopolitics. I mean, I feel that geopolitically this is probably the worst setup geopolitically that I have at least experienced in my life. Or certainly feels that way. We have a war, major war, with a sort of nuclear power, and then we have another type of a Cold War that may grow into economic war with the biggest economic power, which is China. And these two are coming together. So sort of, I wrote that sort of yesterday, does feel that there is a bit of a sort of inflection point geopolitically here. And if you look at the Chinese President Xi and Putin yesterday, made a whole set of new agreements and reaffirmed sort of support and reaffirmed sort of alliance, which ultimately puts the West on the collision course, and Europe is sort of right sandwiched in between, because Europe would like to do business with China both ways, but US is sort of pushing for this confrontation. So a little bit like the energy war back last year, we do have a prospects of this economic war going forward. So also geopolitically feels situation to be quite unstable, and also there's obviously Middle East, and China has been involved in the Middle East past week. So it came as a big surprise for Washington, the sort of Iran-Saudi deal, at the same time when Iran basically have a nuclear bomb, right? The 84% enrichment that was established a month ago, all the estimates are from 84 to 90, it takes you about 2 weeks, and it's 2 weeks passed already. So I think it's probably safe to assume that they have a bomb, or they have a sort of enough material for more than one bomb, and the blueprints how to put it together. So situation, I think, is their market risks, their economic risks, and their geopolitical risk, in an environment where the rates are very high, when consumer is sort of sliding down, it's just hard to be bullish, especially in the markets which are trading close to all-time highs, and Europe is maybe a few percent off of the all-time highs, Euro Stoxx 50 or DAX, so sort of I was a little bit joking with the client, kind of rule of thumb. People always have this rule of thumb, kind of sell in May, go away, or, sell Yom Kippur, buy Rosh Hashanah, so on and so forth. Say like, okay, don't buy the Europe if it's at all-time highs, like there's a chance of a war, nuclear war, and sort of inflation is killing the economy, and central banks are trying to actively to kill it. So it's, in short, we are not positive. Now this is the derivative conference, and I have a few more minutes, so just a little bit about volatility. We think equity volatility is a bit too low here, especially when you kind of compare it to the volatility in other asset classes. So if you look at the sort of bond volatility, this MOVE index is not our index, but it's a decent index. It's kind of highs, almost all-time highs, and VIX in low 20s, low to mid 20s. Doesn't make sense, and we tested these things before. Generally, bonds tend to lead. Bonds tend to know a little bit more about what's happening in the economy. Equities can get complacent. Equity can get sort of technically driven. And the technically, two things driving equity volatility lower. One is this very violent rotation between growth and value. Financials and tech and so on and so forth. So when you have like so much churn within an index, tend to actually reduce the volatility overall of an index. But there is also supply issue. And something we kind of pointed, there is short-term options. There's like 0-day, 1-day, 2-day, 3-day, 4-day options, which are now volumes are enormous, and the net volume of those are selling. So clients, be it retail or institutional, are selling this volatility to the markets. So it does actually tend to congest market with the market being a long convexity, and that kind of puts a pressure on a day-to-day volatility. So there is some fundamental and technical reasons. There's also, as I said, complacency. No landing, soft landing. Problem is solved over the weekend. We can move on. We can rally. So all these things are, I think, putting a pressure on volatility and making the level of volatility to be, I think, too low where it should be, given where we in the cycle, where the rates are, and what type of risks are lurking here. So clients often ask, like, how would you position? So we basically, last year we were saying like we like the emerging market, we like China, we like energy, and we thought kind of things will play out well, but then we kind of flipped, and now the view is basically you probably do want to go in a more towards cash, towards sort of bonds, short-term bonds, 6 months, 1 year. You're getting guaranteed 4 to 5% and paid to wait for this situation to clear up, right? And it's not that you are missing some bottom. Again, in Europe, you're close to highs. You're not definitely close to lows. So I think bonds give you this little bit of optionality, and then option trades. You can do all kind of option trades. As I said, volatility is relatively low, so it does make sense. So clients are looking at upside in volatility. They are going to put spreads, 1x2s, all kind of things. I think it does make sense. And then one last thing, sort of just in terms of a view on the market, in terms of level. So we think earnings in S&P are around 200 this year. Once when we get that 4th quarter of recession. Multiple right now is around 20, so it's not a cheap multiple. Historically, multiples were around 15, 16, at this level of rates. In the crisis, multiples were even lower. In European crisis, debt crisis, multiples around 12, 11, 12. So there are certainly scenarios that can look pretty ugly, I think. But we do think that market will at least retest the lows, which are around 3,600 in S&P. And then in Europe, it's a little bit bigger drop because Europe rallied quite a bit. So I think I'm running 45 seconds to end. And if we do have some questions, maybe I'll take one question or two questions. Yeah.
What role do trend followers, CTAs, play in the market moves?
Mm-hmm. So they do play a role, and especially now because S&P is there's a cluster of levels, 100-day, 200-day moving average around 39.50. So we are above them. So CTAs were buying it last 2 days, last 24 hours of the trading hours. And same thing when we went down after the Silicon Valley, they were selling because we broke these levels. So in the US, they are actually kind of adding to volatility here. We are now above, so I think they bought a lot yesterday and day before yesterday. I do think depends what the Fed happens, and keep in mind, Fed is the is the big event today. So 7 p.m. in this time zone. If we go down, CTAs will sell. So now in Europe, in Eurostoxx 50 levels are a little bit lower, and so I think there is probably downside there as well. But CTAs have been driving. The liquidity is very low. Liquidity is kind of near low. So when you have these multi-billion-dollar quick flows, they do impact the market.
Thank you so much. Yeah. It's a lot of content for a short period of time. Okay. Thanks.